accidentally invited a user to the studio.
Uh-oh.
So I assume people are.
Awesome. Okay, so we're live. Just wanting to check that everyone can hear me okay. But yeah, hey everyone, thank you so much for joining us today. I am so excited to be kicking off Canada's largest finance creator investing roundtable today. My name's Anika, and I am one of the co-founders of Blossom. It's been such an incredible journey seeing our app grow over the last 3 years and this community that we've built all together. And as you may know, we sometimes host these in-person events across Canada and recently in the States. And each time we do so, we get amazing feedback, and getting to meet each community member who's able to come out to these events brings the experience. So today we wanted to try something new by bringing a little bit of that magic online so that more of our community could join in on what makes Blossom the best investor community in the world. So with that being said, I'm excited to share what we've put together, an amazing roundtable today all about investing. This is the first time we're trying something like this, so we're treating it a bit of like an experiment. But we have an amazing lineup of speakers for you all today, sharing their wisdom and insights. Quickly, to give a quick rundown of how the event will go, we're going to start off with a brief introduction to our speakers and our moderator. We have some pre-planned questions from the community on Blossom who left comments on Brandon's post just to kick things off. And the discussion will open up in a very casual roundtable-like format with all of our speakers. And then at the end of the event, we will open up the floor to all of you for questions from our viewers. So with that being said, as the roundtable goes along, feel free to type in any questions that you have in the comments. The Blossom team will be moderating from behind the scenes and will flag as many questions as possible for our speakers to answer during the Q&A period. And finally, this entire event will be recorded and posted on our YouTube channel for later viewing, in case you need to jump off at any point or want to share it with your friends after. And don't forget, if you're sharing anything from our event today on your socials, please tag us at Meet Blossom Social. So without further ado, I'd love to introduce you all to our amazing moderator, who also so happens to be Blossom's fearless leader, co-founder, and CEO, Max.
Awesome. Thanks, Anika. Hey, guys. Love seeing all the familiar names in the chat. We got Bradley saying who's going to learn and earn tonight. We got Mr. Duck, Seymour Duck, Alexandre, a bunch of people. So thanks so much for everyone tuning in here on your Friday evening or afternoon here if you're in Vancouver time like me. Without further ado, it's my pleasure to introduce our incredible creators who are also joining us on their Friday evening for a fun chat about investing. I can't remember whose comment it was, but someone saying they skipped bowling and drinks for the live stream. And so yeah, I appreciate everyone who came out, and we're gonna make it a fun, lively chat. More of a roundtable discussion than some of the events. We wanna make it much more of a lively debate and discussion, rather than too much just question and answer. And so definitely feel free to use the chat to throw in some questions. We'll try and pull from those. And most of the questions I have for the panelists are actually from the ones you guys commented on the post about the event. So thank you to everyone who left some comments. Without further ado, let's get started. Our panelists this evening are creators who've inspired thousands of Canadians and Americans to learn and take their investing more seriously, have collectively amassed over 2 million followers and subscribers collectively. And so let's get into the panel. First up, we have the legendary dynamic father-son duo, Brandon and Marc Beavis, who both previously worked as licensed advisors and portfolio managers before starting their YouTube channel, Beavis Wealth. And Brandon, of course, is also a co-founder of Blossom. Next up, we got Adrian. Adrian has read the tax code and loves to talk about all things investing, taxes, personal finance, money saving strategies on his channel, Canadian in a T-shirt. Adrian, you're just so eager to jump in. Yeah. You're like, oh yeah,
I'm excited. These comments are too much right now. You guys are cracking me up.
No, it's great. Next up, Joyee. After leaving home at 19, Joyee saved her first 100K by the age of 23 and now makes amazing beginner-focused content on her Instagram, TikTok, and YouTube channel, Joyee Yang. Next up, we got, and I saw lots of people in the chat here for the man, Bilaal, one of the more risky investors of the group, love for crypto, swing trading, options trading, which he talks about on his channel, BD Investing. So we got a nice mix of different styles and creators. And last but not least, Richard Coffin, who not only works full-time as a chartered financial analyst and CFP, but loves talking all things investing, personal finance on his channel, The Plain Bagel. So absolutely all-star lineup for you guys, and we're excited to get into it. So for the first question, in true Blossom fashion, we're going to have you each share a bit about your personal investing strategy and your biggest holding, and we're even going to pull up your Blossom profile on the screen while you answer. So let's kick it off with Bevo, Brandon Beavis.
What's going on, guys? Yeah, for those that maybe aren't familiar, my name is Brandon, Marc's son, who we'll be introducing next. And yeah, there's my portfolio. Obviously, for those that have been following closely, major changes as of recently. So this is fresh, a month and a half of making this transition to a pure passive investing approach. That's what I would consider myself at this point, a passive index investor. As you can see, I own 0 individual stocks, and it's a pretty darn good feeling. It's bittersweet, to be honest, but I won't go on and on. We can talk about it through the presentation. But my largest holding is VOO, which is the S&P 500 fund. Any alternative of this, like a VFV, ZSB, they would all serve very similar purposes. But I'm playing essentially the largest 500 companies in America, and along with some others. But my top holding today is VOO. I'll turn it over to Marc.
Hey, everybody. Nice to be here on this group. Quite the opposite of Brandon. My portfolio, I think it's quite simple. It's not overly complicated, but it is comprised mainly of stocks. Now, when you look at the chart here, my biggest holding happens to be cash at the moment. Then I have a couple of fixed income ETFs. From an equity perspective, Apple and Microsoft battle it out. It seems like every day one of them's just taking over from the other one there. My strategy for years and years and years, and just in case you can't tell, I'm one of the older people in the group here. In fact, probably the oldest. But I've always believed in sort of that strategy of buying good quality companies, buying them at a fair value. And I've held companies sometimes for decades. So I'm not a very active trader at all. Those of you who follow me on Blossom will know that, but I do from time to time mix things up a little bit. So almost boring but that's served me well over the years, and so that's I'm not going to change from that. Now, I think I'm supposed to pass you over to Adrian.
Hey guys, it's Adrian here, Canadian in a t-shirt. Thanks for having me. I'm super excited to be here and hanging out with my friends on a Friday evening. So talking about my investing strategy, I have 2 main pillars of my long-term investing strategy, and that is diversification. I want to make sure I have all my bases covered across all sectors, all areas of the market. And number 2 is focusing on the long term. I don't care about what happens next week, next month, next quarter, even next year. I'm investing in companies that have a long-term future. I care about my portfolio 10 years, 20 years, 30 years down the line. Now talking about my biggest investment, it's actually in Blossom itself. But my largest public stock that you'll see on my Blossom page right now is actually Iron Mountain. That is a US REIT, which not only is it a REIT that owns real estate, it actually runs an operating business where they are involved in storing like important legal documents for big companies, and more recently digitizing those traditional paper documents into a digital format. And it's been doing very well for me the past couple of years. And right now it's my #1 holding on Blossom. And now I'll pass it on to my good friend and Instagram/TikTok superstar, Joyee Yang.
I was not prepared for this. My largest holding is cash. This is actually my newest high interest ETF. So there's a lot of controversy around why I spent $30,000 in cash. And my initial strategy was putting all of my money in a high interest savings account. But you guys know that we have to pay taxes on high interest savings accounts. So I decided to just max out my TFSA. Use the contribution room to invest in a high interest ETF to not get taxed, but I'm still going to sell $1,000 worth of cash every month and put it into the S&P 500. Thank you.
Hey, what's up, guys? BD Investing. Thanks for all the love. Don't care as usual. So my portfolio is more of a growth and a bit more risky. My largest holding is actually Bitcoin, and the second largest holding in terms of ETF is VFV. And then in terms of stocks, my largest holding is actually Google. My strategy is like I said before, it's a risky growth investing. So I take a lot of risk in terms of tech stocks. I do also have dividend stocks. I used to originally be a dividend investor, but that didn't work out to me. It was too slow and I needed more growth in my portfolio. That's why I chose to go more to growth. And the growth is starting to pay off. My portfolio is over $200,000. And that's why I slowly transitioned into ETFs. And that's why you see VFV being one of my top ETFs, just because it's a awesome passive income strategy. Similar to what Brandon said, it's a don't care strategy. You get to sleep at night, you don't lose any sleep. And my plan in the future is to make VFV and a Nasdaq ETF like QQC at least 60% of my portfolio. And I see you guys in the comments showing me some love. Yes, I am also an options trader, and I do use options to hedge my portfolio, especially in terms of volatility, like market crashes, or if I like a stock like Nvidia, which I do not currently hold at the moment, but I do think Nvidia would go up, I would either trade that stock using options. So that's my strategy. I'm gonna pass it over to, I believe, the Mr. Plain Bagel.
Hello, everyone. Thanks for the bagel picture. So I'll keep mine short and sweet. I actually still work in the industry, and because of that, it's a little complicated to share my portfolio, and I don't often share individual picks and the like. But a bit about my investing style. I do invest in individual stocks as well as ETFs, but stock selection is kind of the bread and butter for the company I work for. So that's the same investment strategy I implement. I would describe the style as, well, long-term. So focusing on companies that I believe will be around for a long time, so that there's, getting your sleep at night and not worrying too much about that stuff. But I would call it kind of a GARP approach, or growth at a reasonable price, meaning that it's looking for that sales growth and the like, while having an eye on valuation. So we still care about what we're paying for the stocks that we want to be in. But yeah, excited to be here as kind of an honorary guest for the Blossom event.
Awesome. Thanks, Richard. Thanks, everyone. A bunch of stuff you touched on. I think one thing that even stands out is the different styles, is the different investing approaches. And we're going to get into that sort of in a discussion, maybe even get into a bit of a debate here. We're going to talk about the growth versus dividends. We're going to talk about the stocks versus ETFs. But as the first question, since I know we have a big amount of the Blossom audience are beginners, we had two questions geared more towards beginners, which we'll kick things off with. One is from Momentum Finance, which is, what advice would you give to beginners just getting started? Or also we have from Jeff and Vikas, what's one mistake that you've made or mistakes that you commonly see others make? And so to kick off the first sort of discussion, feel free to touch on either of those topics. And Joyee, why don't you start us off, and then everyone else feel free to chime in, and we'll do it more round table. Feel free to interrupt each other and all that good stuff. Let's get into it.
Thanks, Max. I think a really, beginner investor, when I was beginning how to invest, I put too much money in a high interest savings account. So I was really, really, really risk adverse. And instead of putting just the regular 3 to 6 months worth of living expenses in a high interest savings account, I put a whole year's worth. I could have made a lot of returns in the stock market. One thing for beginner investors, I always say, just get started, even if it's $50 a month, $10 a month, $100 a month. It's very important to get started, get used to the stock market, and earn the compound interest.
I'll just jump in there. That's one thing I've always preached as well, is like, even if you're starting with smaller dollar figures, like you have to get started, and the biggest part is getting that habit going, right? Like developing that habit. And it's easy now. Obviously, I've been investing for, like, it's crazy to say, but almost 20 years, because I started young. I am still relatively young, but when you start, like, at this point now, I don't even think about investing. It's just natural. It's automated. It's just part of the lifestyle. But when you're a beginner starting that, like, you need to commit to that process. And I think the most important part there is developing that habit. So yeah, it's the most age-old advice, which is like, just get started as soon as possible and with as much as possible. But it's age-old advice for a reason, right? There's no one in this chat that I think would disagree with that statement for our beginners. Just getting your foot wet in the market.
I'd also maybe add to that, to as much as possible, automate it. Don't have to make a decision every month or every paycheck if you can avoid it. Just have it so it automatically goes into an investment, transfers into an account. That's probably one of the most important things too. You can't. It's harder to fall off track that way.
Yeah.
I see Braden. Sorry, I see Braden started on his 18th birthday, and I started on when I was 18 as well.
Oh, nice.
Sorry,
how old are you now, Mark? 24?
Maybe flip those. Yeah, 16.
I liked in your intro you said I might be the oldest one in the.
Yeah.
You're like, maybe not.
Maybe.
I'll jump in on the kind of common pitfalls. And apologies if you hear a kid screaming in the background. My wife is currently wrestling two boys for my benefit. So when it comes to common pitfalls, especially in stock selection, I think one of the biggest things I see beginners getting into is a lot of people view investing as, picking stocks based on like headlines or what position is going to be big and do really well. And I feel like one of the first steps a lot of people do is just buying stocks that they've read in the news. And it seems like that's how most people start, even before they've understood much about investing. It's just, well, I'm going to buy the stock because I heard a headline that's going to do really well. And I think recognizing your own limitations as an investor and whether you're a beginner or not, you should look to rely more on those kind of managed products and solutions like ETFs, like broad-based index funds or other products when you run into those kind of situations where you feel like you don't have that experience. There's always the core and satellite approach where you can put most of your money in that solution, then practice with a smaller portion so you manage your risk. But I'd say that's a common pitfall. I see a lot of people kind of start right away with stock selection.
There was a question on that, a comment on that: core, satellite, core, and explorer. These terms are interchangeable, but yeah, maybe just for those that don't know, Richard, do you mind explaining exactly what that means?
Sorry, interchangeable for what? Sorry, I missed that.
I was saying just a core satellite approach or a core and explorer.
Oh, yes, sorry. So yeah, core and explorer. So core being you put 90% of your money or some deviation based on how comfortable you are in a managed solution. I call managed solutions basically anything that's broadly diversified or has someone in charge of it. That's you're exporting the stock selection process. And so 90% of your money, say roughly, in sort of one of those solutions that's more prudently managed, and taking 10% of your money or some other, again, variant of that, and practicing your research, your stock selection with that basket, so that if you fail, one of the best ways to learn with investing is failing, but you don't want to risk your whole retirement just to learn a lesson. So that's kind of a nice way to play both sides. If you are interested in stock selection, which a lot of people don't have to be successful investors.
Just really quickly, there's a gap here. Richard, I totally agree on that. And one of the things I found when I was working directly with clients is you could have clients who were almost by nature more conservative, say 40 plus, 50 plus. So they have a relatively blue chip portfolio, but they have this need, I would have almost called it, to explore, to have a little bit more risk in their portfolio. And so you can almost equate a core and explore strategy with that, where most of your money is in something really blue chip, and then you can take that 10%, whatever it is, and have some fun with it. Key there, if you lose it, then you're not going to be down and out.
Yeah, I'd say that's really common among clients. Actually, you'll have someone who's actually well established for retirement, and they're still like, maybe take 5% of my account and put in some stocks they think might have a big potential. It's like, all right, if you say so.
Scratch the itch. Yeah,
that's right.
Yeah.
In terms of oh, sorry, Max.
No, go ahead.
In terms of beginner mistakes, you guys touched on everything that was good. One thing I most commonly get DM'd about is like cheap stocks to buy or what are cheap stocks to invest in. And I think the mistake most beginner investors make is, they think price is relative to value, meaning they think a cheap stock, like something that's $5 or even a penny stock is going to do $100. Meanwhile, when you invest in a stock like Nvidia, which was priced at $300, went all the way to $1,000, that had nothing to do with price, but had everything to do with how great the company was. So I would say one of the mistakes I made early on was trying to find cheap stocks or stocks less than $10 and hoping they would, 100x, 10x. But what I did to fix that was to actually put myself in the shoes of that stock or company and actually think like, hey, what if this was a company I owned? I need to make sure that this company is actually profitable, making money, growing its revenue, and is actually a fair value versus trying to look for risky penny stocks. And yeah, I don't know. Let me know if you guys agree on that as well.
Absolutely. Yeah.
100%.
Yeah, my biggest mistake was also the risky penny stocks below. When I first started investing, the biggest thing was, I think you guys have said, like, experimenting and reserving some of your portfolio. And I think even who's the famous investor that says that, you can put aside like 5% for more of those risky bets. But I ended up just putting way too much of my portfolio, way overexposure into very, very risky, like, penny stocks when I was like younger, and then you got burned very, very quickly because you're chasing that sort of get rich quick approach. I think a lot of people when they're starting out, especially younger people, can fall for that.
I mean, it might work out in your favor, but then you decide to not look at the market one day and boom, you're down again. So there's risk to that type of market versus when you buy like a blue chip company and just sleep on it, you have a better chance of winning in the long term, I would say.
Mm-hmm. Yeah. Anything else to add on this topic before we move to the next?
No.
Actually, there was one comment that I think was worth showing here from Amy. A lot of us talked about getting started young. Some of us got started when we were 18. Is there any different advice you'd have for someone starting in their 40s?
Start ASAP. Just do it.
Yeah, ASAP. I would say fundamentally, no. Just start as much as you can. Maybe I would say, depending on your circumstances, if you're 40, have less time to build a portfolio, maybe be more aggressive with your investments. I think being relatively aggressive younger is awesome too, because you get such a head start. But there's not, from actual how you manage it, I don't see anything different personally.
The one difference I would say is make sure you know when you will need this money. Like, make sure you have a plan. Like, within 5 years, 10 years, 15 years, I'm going to retire and going to start withdrawing from that portfolio. Because when you're 20 years old, you're not even thinking about retirement. Like, you literally have decades to kind of weather those storms. But when you're starting in your 40s, it is a much shorter timeline. And that doesn't mean you're going to withdraw your entire portfolio on retirement, but there's a certain amount, whatever that amount is, that you will withdraw on your, once you retire. So keep that in mind. And for whatever that amount is, that part should be probably a little bit more on the conservative side. But like Marc said, for everything else, if you want to kind of catch up, you could be a little bit more aggressive there. But keep in mind what the amount of money that you will need to kind of pull out from.
I have to jump in again. Thanks, Adrian. When I said aggressive, sorry, I didn't mean to come across as being aggressive with your investment choices. Not at all. Be aggressive with your savings rate. Right. So take as much money you can out of cash flow and put it in. So if it came across as, hey, take more risk in your portfolio.
When I heard that, I was like,
I was surprised.
That's an uncalled for statement from you. I didn't want to correct you. I was like, oh, damn.
No, I'm glad you mentioned that, Adrian, because that's probably exactly the opposite. Just be aggressive with your cash flow, with your contributions, but not with your investments. Thanks for clarifying that.
But Adrian, I think it's a good point around the goals, right? Like, different goals will have a very different impact on what your investment and your portfolio should look like. And I know with Blossom, like, that's one of the things we often say is, even though we're all sharing our portfolios, like, don't copy them, because we all have different goals, different time horizons. You mentioned if you're saving for retirement, but even if you're younger and you're saving for a home or a down payment, right, in like 5 years, your portfolio should probably look very different than, if you're saving for retirement in like 30 years. Is that something, especially Marc and Richard, I assume that's when you work with clients, right? That's one of the first things you go through is people's goals.
Yeah, goals and time horizon. Yeah. And so I was going to comment on the 40 thing, you do keep in mind that at 40, you still, like, if you're assuming, because we're in Canada, 65 is kind of the commonly used milestone for retirement. That is still 25 years to invest. So it's worth keeping that in mind as well. But yeah, financial goals is probably one of the, time horizon is really one of the biggest determinants or thing that's going to determine how you invest. And that's going to be goal based, right? Retirement's kind of the one a lot of people focus on, but that can be buying a house. It can be buying a new car. It can be a lot of stuff. And the rule of thumb I always highlight is, there's no perfect answer for everything. It always depends on your situation. But generally, if you need money within 3 to 5 years, it's not worth putting in the stock market, just because we've had periods of 3 to 5 years where stocks have been down quite a bit. It's just not worth the risk at that point. But I'll let Marc chime in as well.
Yeah, totally agree with that, Richard.
Mm-hmm. All right. Well, one of the things we've already touched on a bunch in the chat so far is sort of stocks versus ETFs. So I want to show up this graphic brought to us by Blossom Pro, where you can see this for yourself if you look at anyone's profile or portfolio. But it's essentially the breakdown of everyone's ETFs versus stocks. So we can see, Brandon, I think you have the biggest exposure now to ETFs. Adrian, surprisingly, and BD.
I know. I can't believe I'm beating Adrian in ETF.
I could clarify that point. This is a little deceptive because on Blossom, I'm only showing my TFSA and RSP and FHSA.
Lies, all lies.
In my corporate account and margin account, it's.
I want to debate now, Adrian.
Focus.
Amazing. So why don't we use this to sort of kick off discussion around, what are your thoughts on like stock picking versus ETFs? Who should be doing more ETF investing? Who should be doing stock? Or even why you have sort of chosen this mix for yourself?
Well, I mean, why don't I kick it off? I mean, mine being quite the interesting chart there, being full purple. And I think actually, like Richard alluded to it really well earlier in the conversation. I think best practices is, especially when you're starting out, like I assume, let's say you're watching this, you're a beginner. Like I always like to say default to, the broad-based index approach. Richard was referencing it to the managed approach. Let's just call it ETFs, broad-based, the fund. It's very, very difficult to go wrong that way when you're starting out. And in fact, not just when you're starting out, for the entirety of your investing career. And like what we've always said was, and it's very counter because, my portfolio was individual stocks, but we would always say you want to start off with that broad-based ETF. And as you get more experienced, as you learn more, and if you deem you're someone that like has the intelligence, the time, the care to add individual stocks, you can start incorporating those, right? Now, again, I'm in a bit of an interesting position because I just went the other way around, right? Like I went from stocks to ETFs, and that was more or less a decision based on my lifestyle, desires at this point in time. Like Richard, I had a crying baby over here too. So the wives are all playing their part. They're doing a good job of keeping them under control. But the time that I had to manage a portfolio of individual stocks has gone down, significantly in the past couple of years. So in my opinion, it called for a very timely change to go that passive approach, because the amount of time that it frees up when you are offloading that to a fund manager or to a broad-based fund versus managing it yourself, it truly is night and day. And that's hard to like explain and know the difference till you've seen both sides, but it is an incredible difference. So like everyone else has said throughout this conversation, it's very personal and it's about what what you feel comfortable doing. But I can vouch certainly for this passive approach if time is a priority for you.
Yeah. Well, one thing I'll echo, and also, I'm sorry, Joyee, you go ahead.
Go ahead, Adrian.
I'll keep it quick, I promise. Yeah. So kind of echoing one of Marc's earlier points, try to automate it as best as you can. And ETFs are such a powerful way to automate it because you don't really need to make any decisions. You don't have to worry about, timing it before the earnings call or timing it before the ex-dividend date. An ETF, like a broad, diversified ETF, you could literally buy any time of day, any week, any quarter. It doesn't matter. If you have $100 a month, every week, every 2 weeks, whatever your schedule is, I can buy an ETF with my eyes closed. And that's a safe, stress-free approach. When it comes to individual stocks, that's where I can't just kind of pull the trigger blindly. I have to kind of, do a bit of research and kind of check out how it fits with the rest of my portfolio. Is it a good time now? Is it a good valuation? But with ETFs, I could really, I could basically buy that on autopilot. So I would say, especially for beginners, if you're focusing on the automation stage, ETFs are definitely the way to go.
Yep.
And then even like, this is exactly what I did. This is like a comment I just saw. It was like the all-in-one ETF. You have products like this, which now do the asset allocation aspect for you too, where you can essentially buy one product and have it all done. It's very, very, very easy.
I think.
I'll go ahead. Yeah.
I think I will always be in the automation stage. I mean, VFV is my biggest holding other than cash. I will always, automatically invest $1,000 into the S&P 500, but I also have a thing with dividend stocks as well. And we're going to talk about that a little later.
Mm-hmm.
A couple of quick things I'll point out. And Richard, you probably spend a lot of time speaking with your clients about this as well. They're related to indices. And the first thing we all have to really keep in mind, and I agree with pretty much everything everybody's saying, but VFVs come up, VOO comes up, the S&P 500, we hear that a lot. Every 10 years or so, you can expect that investment will go down by, I'm going to call it 50%. Could be 45, could be 53. But when we have those major corrections, and that's a normal part of investing, but we tend to maybe fall into a bit of sense of security with, it's broad index, and so it's a no-brainer, et cetera. It is from the mechanical perspective, but it doesn't mean that just keeps going up all the time. It rides up and down, really important, especially if you're going QQQ or something like that, where you're, the swings will be much more. That's really important. Also, you're going to hear a ton where if you're in individual stocks, which I'm primarily in, well, if 90% of fund managers don't beat the indices, et cetera. So why would you bother? I'll point out my index that I measure my portfolio off isn't the S&P, isn't the TSX, it isn't the QQQ. It's what I need. So I know my circumstances. I know a rate of return that makes me feel comfortable. I know the risk that I can take. So pretty much always, if the NASDAQ spikes up, I'm going to underperform that. But when there's a correction, I'm going to outperform that. And so each person, I think, needs to look at what you need for your own circumstances and make your own little, whether it's a balanced index or whatever it is. I'm not looking to beat an index. Sometimes I do, sometimes I don't, but it's irrelevant to me. And so when you hear that from a lot of people, just factor that in as well. My 2 cents worth.
Yeah, especially
Mark,
with
maybe?
the S&P, especially with the S&P 500 since the 1990s, like you had Coca-Cola and Exxon being one of the largest holdings to now mostly tech stocks. And the great thing is instead of stock picking, the S&P 500 or the ETFs would just change their allocations accordingly. So that way you're keeping up with the market versus trying to almost verse or fight the market. So yeah, Mark, you make a good point on that.
Yeah. One thing to highlight too on the S&P 500, not to diss it, because I think, this could have come across as saying, well, the S&P 500 is going to do poorly. And that's not what I'm saying. It's been an incredible investment. But you do have to keep in mind that it is an index. It's the most popular index, but it is also in a way, I know we're kind of talking about stock picking and stuff, but it is in a way an active bet you're still making in some way. And that's okay. But I think when it comes to index investing, you do have to recognize when you're still making a decision versus, so you have to know your product, right? An investment in the S&P 500 is still an investment in primarily large cap US stocks. So that is in a way an active bet that you're saying out of the world of stocks that exist out there, I'm betting US stocks, primarily the large ones, will do the best. That's worked out great in the past. But I think to Mark's point, an important part with whether someone should invest or not is you should really align your investing style to your kind of personality when it comes to your risk tolerance, how you feel about investing in businesses and stuff. A growth investor who has a value portfolio is going to be less likely to stick to that strategy when times get tough versus if they align what they're investing in with their own beliefs and the like. So that is a component to understand as well. And same thing, I think people kind of view index investing as I don't have to think about it. And that can be true in certain extents. You definitely don't have to think as much, but it's important to also be informed on what you're investing in, where your bets are being made so that you're not going in blind.
Mm-hmm. One other important point, just to echo what Richard just said, is like also remember as you age or as your circumstances change, like when you have kids or whatever, your goals will change and your investing style may change. And so you might do something like what Brandon did, where he went from pure individual stocks to ETFs. Or if you are like a mainly ETF trader investor, maybe the indices, the ETFs you're going to invest in, that can change, right? Yeah. You might go from like an S&P 500 or a TSX composite focused one, like the North American focus, to a more international or a more all-in-one ETF, or maybe a more fixed income or bond focused ETF. So within the ETF like ecosystem, there are so many different styles of investing within that, and that can certainly change as your life changes too.
Mm-hmm.
more on the stock picking side, we had a couple questions more around how you guys go about that and choose the companies that you choose. From Amy in one of the comments, how do you validate which stocks to pick? What are some of the basic things that you're looking for? And especially geared towards those of you who have more stock picking in your portfolio.
Okay, I'll start it off. So I kind of like to see myself as an analyst. I like to break down companies, look at 10Ks, read earnings report and whatnot. And the choosing a company always changes every year. Either it's, hey, the revenue is up, but the revenue growth didn't perform correctly. So you know what, the stock is going to go down. But all in all, at the end of the day, what I've seen consistently is as long as the revenue is up, the earnings are growing, and the company is not losing money, that's one of the main things I look at is the company profitable. And some of the margins I look at is the gross margins, the profit margins, the net margins, and especially free cash flow. And I pretty much have a stock picking list with like a check where I would check mark each box if it meets the criteria. So I would probably have at least 15 criterias on that list, and at least 7 to 8 of them have to pass. So 70 to 80% of it has to meet the exact stock picking list. And I'm sure many of us have that kind of list where we choose stocks accordingly. And you can easily Google one, just a stock picking list, and I just break it down. And some of the apps I use, we have a Daniel Pronk's app, which is Stock Unlock, which is so easy. You just put in the stock, it'll give you like a stock score out of 5, and that has made my life so easy. Versus if I showed you guys, I have like a bunch of papers over here where I used to just like print off Yahoo Finance of the stock, and I used to use a pen. But now I don't even have to do that. I literally just insert it into that Stock Unlock app. And another one which is great, especially if you're more into breaking down business, is FinChat, and which is Braden's, which we know. And yeah, those are some of the tools I use. You have to use the tools, and you have to kind of look at each criteria.
Yeah, we're thinking about bringing both Braden and Daniel actually for one of the future panels, because both are very knowledgeable about the
awesome,
AI.
Man, they're awesome.
So shout out both of those guys.
Yeah. I'll just say, Bilaal, what you're speaking with, at least in the industry, we call it a tear sheet, and it's a list of all the criteria that you would be looking for. And Brandon, you'll remember when you started working with me, that was one of your major jobs, is to go through all of the companies that we own or in our model
Looking
portfolios.
tired of filling out those tear sheets, yeah.
But it depends on your type of investor. I mean, I would look at things, because I'm more of a value-oriented investor, things like PEG ratios, PE ratios, price to books, free cash flow. Those things are important to me. Whereas if you're maybe more of a growth-oriented investor,
yeah, very different things you look at. Yeah,
you'd be looking at different metrics. So I think it really comes down to the style of investing as to what specific metrics you'd be looking at.
Yeah, it's tough too, because industry matters a lot as well. Like the type of industry you look at will dramatically change what you care about and what you look at. Like if you look at a utility company versus a tech company, it's like night and day. And same with like in Canada, gas and oil. It's one of our biggest industries, and analyzing those companies, it's actually quite difficult. It's funny, when I first started my job, there was a primer I had to read through. It was like 100 pages long, and it was like just how to analyze oil and gas companies. It's so different because there are industry specific metrics to look at as well with those types of companies. But I think that's what's unfortunately tough about it is, for me, I don't know if I could highlight, 5 things that I look for in every stock. There's certainly things I want to look for, like profitability is a big one, manageable debt. I don't necessarily look for no debt, but I want it to be manageable, or a path towards, sustainability, that things are improving. But it really does change from company to company. And I think one thing I've learned over time, I used to do a lot of more quantitative focused stuff where I would use filters and the like, and then get my company and say, okay, that's the one I want to invest in. And then when I go through their statements, I take all their quantitative data points and compare them to their peers. And that is helpful, but I've come to learn that the qualitative side is just as important as the quantitative. So there's unfortunately, not a program that will spit out based on these stats, this is the best stock. That is half the battle, but the other half is genuinely understanding what the company does, what the brand is, what the products and services, how they compare to competitors. And so over time, it's funny, I've actually put more weight on those factors, or I've come to appreciate those factors more. Whereas when I started off, and I think it's probably from my learnings and education, it does kind of, because it's easier to explain the quantitative side. I've had to kind of unlearn some of that stuff to focus on those qualitative aspects a bit more.
No, Richard, that's an excellent point. I was actually going to make that exact same point. Like, so many people focus so much on the numbers, right? On the quantitative side, but the numbers don't tell the full story. At the end of the day, a stock is not some magic ethereal thing. It represents ownership of a company. And you have to understand, what does the company do? What kind of value does it offer to its customers? What projects or new developments is that company working on, and will that yield, growth in the future? That understanding those, being able to answer those questions is essential. If you can't, talk to your neighbor or a stranger on the street and explain to them what this company does and what's the pathway for progress, for growth, then you should not invest in that company. For me, that's like a deal breaker in terms of picking criteria. If I can't explain what this business does, I don't want to invest in it.
And there's
and I see it.
Go for
Sorry,
it.
go ahead.
Go for it. You go for it. Go for it.
I was just gonna say, I see one comment about like PE or cash flow and stuff, and that's another aspect as well. So cash flow, I think one thing to bring it back to the conversation earlier about when to pick stocks, I think genuinely understanding accounting is a really important step. And if you don't understand accounting, I think you should look into learning accounting before you try to do stock analysis, because it's just so important to understand the differences of stuff. And it's good to understand earnings, but also to look at cash flows and the like. But in terms of valuation, it's funny. I actually had someone talk to me about this yesterday. But in terms of how to value a stock, again, differs from industry to industry. You might have heard of things like discounted cash flow models and the like. And those are really handy mental exercises to go through. However, the industry actually doesn't do a lot of that. And if you look at, say, sell side or buy side reports, meaning that they're professional analysts who are giving you reports that they've spent their professional career putting together, there's not a lot of DCFs. You'll see some of them, but what's more common is to look at the relative valuations. So that's things like PE, EV to EBITDA, price to free cash flow, or some sort of derivative of that. And looking at all these relative valuations compared to peers, compared to the company's history. And then the other thing is a reverse DCF. Some people will do that, which is you take the stock price that's currently trading at and kind of try to understand what are the estimates that are going into this price, and do I think the company will do better or worse than these estimates? And those more simple approaches compared to a DCF, which is basically forecasting everything on the financial statement that the company is going to achieve in the future, because there's so much forecasting, it's just not overly reliable. And I think the industry has come to appreciate it. Looks really nice and it feels like the right way to value a stock, but there's just so much estimation and forecasting going into it that at the end of the day, you're spitting out a number that's just, it's unlikely going to reflect reality, because there's so much room for error with what you're putting together. So you do see a lot of people rely more on those relative valuations.
I think what we're hearing there is that there clearly isn't one way to do it, and I've always felt that you need to approach it from both angles. You think of fundamental versus technical, and I actually incorporate an element of technical once I've done my fundamental research. I just try to fine tune things, and vice versa. So it's way too complicated to just think it's one thing.
I think I speak for a lot of beginner investors, and which is probably a lot of the audience, is that stock picking is no small feat. And you, like Richard said, you have to learn accounting. You have to know exactly what numbers to look at in their balance sheets. But I'll add something super simple. And you guys know I love my dividends. So when I started investing in dividend stocks when I was 19, I didn't know what a PE ratio is or cash flow of a company. But what I looked at dividend stocks is their track record. So the dividend aristocrats, the dividend kings, that's kind of like my kind of way to value a stock, is whether they have a good track record or not.
And I think another thing that Joyee, you touched on, and even Brandon, I know one of the big reasons you switched is that what you guys are saying, if you're a beginner, it probably sounds very overwhelming. It's, if I'm working full-time job, maybe have kids, how am I going to learn accounting, right? So Brandon, I know that's why you said, right? Obviously with you being so busy with Blossom, and also having a family and also running the YouTube, that was a big motivation for you switching right to ETFs. And I know Joyee as well, that simplicity you've mentioned is important to you to just be able to, as you guys called out, you're still making some choices, geographical choices, sector breakdown choices when you're doing ETFs, but it's not quite as much research.
It's a strategy for the simpletons, is what you're trying to say. You see, the more purple you have on the line, the more of a simpleton you are. So we like it that way.
Listen, stock picking is just funner.
Definitely, that we cannot argue. I cannot argue with that.
It is more fun, but also it's all this research that we're talking about, all this analysis. It's an ongoing process, right? You don't. But it's fun.
It's fun. It's fun doing it,
right? Oh, I agree. I love it. Like I look forward to the earnings and seeing, did it match my projections or did it beat it? But it is, you have to do the dirty work. You have to sit down.
It's like I always said, investing in the stock market, especially if you're stock picking, is just professional gambling with lots and lots of data, right? But they always say you only
socially acceptable form of gambling.
Yeah, but Peter, I believe it was Peter Lynch that said you only need one of your stocks to be right for them to do 10x or 100x, right? So I guess it all evens out.
That's a dangerous quote, though. That's
yeah, you got to be careful with Peter Lynch quotes.
Yeah,
great mastermind with the 2008 financial crisis, but he's also predicted. When you predict 80 financial crises, it's easy to be right once.
Well, Joyee touched on a topic that I know a lot of people want us to get into, which is dividends. So I want to jump into that. And we have, I thought, two very funny questions that illustrate this perfectly on Blossom. So from Frank, he asked, what's the deal with all the dividend hating? And Cameron asked, why do people still waste their time with dividend investing? Very opposing.
Yeah, why?
Yeah.
Why, Joyee? Why?
And I'm sure those two people are good friends in real life.
Yeah. Well, Joyee, do you want to kick us off of sort of what brought you into dividend investing?
I guess. Well, I think, dividend investing or growth investing is what kind of people debate about a lot. I think it really depends on what you need personally. I mean, investing is personal finance. I think for me, I like the predictability of dividends. And, when you're looking for growth stocks or evaluating stocks, again, no small feat, but you still kind of have to, it's like BD said, like glorified betting. I'm super, super risk averse. So I rather have like a projection of how much dividends I'm going to get or how much my account's going to grow. I was thinking about a stock like Peloton, for an example. They used to be considered a growth stock, right? And where are they trading at now? Like $5 USD. I know a lot of my friends have invested in Peloton, think it's a growth stock. So I know I'm like cherry picking here, but there is a difference between, I guess, growth stocks where you have to choose and bet on which stock to choose, and then there's dividend where there's more predictability. That's what I would say.
I'll jump in and add to that, Joyee, because and I know a lot of you guys maybe here won't agree with me, but I am definitely on team dividend. So I am like pretty strongly on that mountain where, yeah, I think especially for beginners, it certainly shouldn't be the reason why you select a stock. I think that's where a lot of the confusion comes, is that, I see this dividend, and certainly some even have these nice high dividends, and that's the determining factor that what draws people in. And that's not what I'm trying to say. But in my personal belief, when you're looking at the different companies out there, like there's really two reasons why I think dividends, it's a great approach to fall back on. I guess for anyone that's been in business, like if a company's paying a dividend, like first of all, that means they're profitable, right? Like let's think about that. If you understand what a dividend is, a lot of these young, fresh companies, the newer ones to the market, the tech stocks that are booming, they don't often pay dividends very early on in their life phase. Because they simply aren't in a position where they can afford to do that, right? Like they either aren't making profits, they're reinvesting their profits, yada, yada, yada. When you see companies that have been paying dividends for like you said earlier, the track record of 15, 20, 25 years, like to me, what that immediately indicates, there's a couple things. A, it's a profitable business. There are some where they're doing something that's working. They're able to, at least from a company management standpoint, that's become a priority for them. That's something they want to, I guess, focus on. And again, it's not to say obviously any stock that pays a dividend is perfect. That's far from what I'm saying. But as a first kind of screen, to me, that does provide me a slight layer of comfort to then dive deeper, right? Because it's challenging for anybody that's been in business, has their own company, startup, whatever it is, like to remain profitable to get to profitability and then, sustain that for 10, 15, 20, in some cases 50 years. That's very, 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 it's challenging. And it says a lot about whether the company has a moat or a competitive advantage that's working for them. I think secondarily, what I'll just finish with is especially for that beginner investor, like, I don't want to say dividend stocks are safer because I don't think that's technically the right term, but you mentioned that, like a Peloton or a growth stock, if you buy into a much more aggressive strategy that's way more focused on growth, and the type of companies you're looking at are more aggressive, the psychological, I guess as an investor, you have to expect, you can expect more volatility and more ups and downs and a much more wild ride. And I think for those new entrants to the market, again, assuming you're starting to get into stocks, that can be quite like troubling for some, that emotional aspect of holding a bunch of stocks that are seeing 20, 30, 40% swings. And that may lead to someone making a poor investment decision, more of a reactionary decision about, oh, the stock's just plummeted. So I think in general, I certainly am on the camp of Team Dividend because, again, I think it displays they're a stable company. Obviously, the income's nice, but that's not the main reason. But yeah, and especially dividend growth stocks. I forgot to even mention dividend growth stocks, but that's actually where my sweet spot is when it comes to the individual companies, that they're increasing their dividends year after year.
I think that. Yeah, everybody's got something to say here. Go ahead.
Yeah, the psychology of it is like
it helps with the psychology.
Yeah, because in order to get a dividend, you have to hold the stock, meaning there's less volatility in the price, right?
True.
Again, beginner investors, when they see the stocks going up and down, which growth stocks sometimes will do, they kind of get scared and they sell. And there's another question that I always get is, dividend stocks never grow. But I think there's dividend growth stocks. Like if we look at McDonald's, they've been paying a dividend for so long, yet they're still performing
yield
very
is low.
well. Same thing with
yield
Coca-Cola.
is low,
but you get the best of both.
But the yield is low, Joyee.
Well, I do want to hear from maybe if anyone has an opposing viewpoint, because in the chat there's a number of questions. This one sort of comparing with the S&P. I mean, Brandon, you mentioned a lot of the dividend stocks are more mature companies, utilities, banks,
100%.
etc. Right? Versus S&P, I think 40% exposure into tech right now. Yeah. Anyone have a counter, I guess, to Joyee?
I'll do a quick counter. So
whoa, hold on. Adrian.
I also love dividends. Don't get me wrong. I absolutely love dividends. But I think where a lot of the trouble arises and where a lot of the, frankly, anger towards dividends comes from is when people start chasing dividend yields. Like what Bilaal was saying, oh, it's a low yield. Because a lot of people, if they see a 3%, 4% dividend, they're like, oh, that's a waste of my time. I want a 12% dividend. I want a 13% dividend. And once you start chasing those yields, that's where the trouble comes in, because a dividend, again, like when you're investing in a company, remember, you want to invest in a company that's profitable and you want to enjoy those future profits. And you can do that through collecting dividends, but ideally you want to be collecting dividends and long-term appreciation. Where what you see a lot of times is a lot of companies that are in financial trouble, they will try to entice investors by jacking up their dividends, right? And once you see that, that's a huge red flag, because like what Brandon made a really important point that, when you have those dividend aristocrats, those long-term dividend players, they are generally speaking profitable, and they have a history of decades of increasing dividends because they have that reliable cash flow. But the companies that are in financial jeopardy, they'll jack up their dividends, get investors excited for the short term, and meanwhile, behind the scenes, they're bleeding themselves dry. They cannot afford.
Adrian, you know what's funny about that?
Yeah,
it's to highlight what I think Bradley said about Bell. So for Bell to actually pay their dividends, they paid their dividends, but guess what? The week after, they laid off like 7,000 employees.
True.
That's so like,
and Bell's not even that extreme of a situation. We've seen even more extreme cases, even from big companies, right? And they kind of get suckered into this lure of security with a dividend stock, right? And then it's just kind of sometimes dividends can be a way to kind of sweep the trouble under the rug. And then really there's really trouble brewing, and this company is in trouble. And once they kind of run out of runway to kind of pay off that dividend, then they'll either cut the dividend, like slash it in half, or cut it entirely. And now you're left with nothing, and the stock price is probably going to plummet. So at the end of the day, it's not about just chasing dividend yields. It's about dividend sustainability and ideally dividend growth. I think we could all agree there. That's kind of the main sweet spot you're looking for dividends.
And guys, I'll say here, we've gone back to like dividends or non-dividends, and most well put together portfolios are going to have a mixture of all. There's some very profitable companies that have grown a lot that pay a dividend. There's some companies that don't pay a dividend who've gone bankrupt. So we can't just silo these and go it's one or the other. The S&P 500 versus dividends. We think, okay, utilities, etc. But the S&P 500, a lot of companies there pay dividends. I think of the FANG stocks, like half of them pay dividends. Very low. I know, Bilaal, you'll say, oh yeah, they pay a small amount. But if you are excluding dividend-paying stocks from your portfolio, half of the FANG stocks are out because they do pay a small yield. So it's got to be, you got to think deeper. And to your point earlier, Brandon, is we can't just think generically like this. There are every year, one of the things I used to do with my clients at the end of every year, we'd look at, okay, what worked and what didn't work. And there's always something that doesn't work. And you go to Disney, it's great for years and they cut the dividend. Or, the banks are always raising the dividend. There's a financial crisis and the government says you can't raise them. So that's a flag, green or red. But then you always got to look deeper. You can't just say, oh, it pays dividends, so I'll buy it, or it doesn't, so I won't. That's my thoughts.
I'm really keen to dig into this because I've done a lot of stuff on dividend irrelevancy theory and all that stuff, which I promise I won't bore people with that. But
please bore us.
I'm dividend agnostic, meaning I don't inherently care if a company is paying a dividend or not, because at the end of the day, the dividend is just a method of returning capital to investors. An alternative way is a buyback, for example. And if you only focus on dividend stocks, you avoid every company that's doing a buyback, which theoretically is equivalent to a dividend. It's just a different method of returning capital to investors. But when it comes to dividends, dividend irrelevancy theory, it basically argues it doesn't matter whether they pay a dividend or not. What matters is the underlying profitability, right? Whether a company pays a dividend or not is sort of irrelevant. What matters is whether that company has profits, right? I think a lot of people use dividends as a barometer, but to Adrian's point, that can sometimes be misused. Like Walgreens, for example, I like to highlight, was a dividend aristocrat and has done terribly over the last few years, having struggled now. And there are companies that misuse that and the like. And unfortunately, a lot of people kind of use dividends to oversimplify stuff. But it's irrelevant to the analysis of the actual company. What matters is this company making money? That's not to say dividends don't matter for the company. There are companies where a dividend is more suited because they are more mature, in which case they should return more capital to investors. And there are great companies like Google historically, which didn't pay a dividend, but had such a high growth opportunity that it just reinvested all the money back into its corporation. So I'm definitely dividend agnostic, but all to highlight that to the other points, there's a lot more you have to look into to make sure if you are getting a dividend that it's sustainable, that they're able to pay for it. Because at the end of the day, if you take away the veil of stock markets and you just think of a business, if a business makes $1 million and then can either pay that $1 million out and be sold for its price less $1 million, or keep that $1 million and be sold for its price plus $1 million, it's irrelevant, right? It's taking money from one pocket and putting it in another. What matters is the actual generation of that $1 million in the first place.
One quick point on dividends that I've heard is around the psychological benefit. I know, even just looking in the Blossom feed,
that's a good point.
Feeling around the milestone and the passive income and the mentality that you get when you see that dividend starting to grow. What are your guys' thoughts on that? And do you think, especially for beginners, is that a real benefit, would you say?
Yeah, I'll chime in just to backtrack a little bit on that aspect, because I think that's a good point. Dividends do simplify stuff for investors. So it's not to say there's not value in that for some people, because half of the struggle with investing is psychological. So if you find you invest better with dividends, then that's great. So long as you're doing so prudently and looking for, those other metrics. And, the kind of part of dividend irrelevance is because the price of a stock drops the day it pays a dividend, They argue that, well, instead of collecting dividends, you can just sell a part of your stock every month or so to simulate a dividend. Well, for a lot of people, that's a lot of extra work. So there is a benefit in that regard. But, I think you have to kind of look past that mental model of dividends is the same thing as the company's profits, because what you see is companies don't pay dividends based on the profits they've made. Because of those behavioral things, they take advantage of investors' behavioral shortcomings. And what companies tend to do is they try to smooth out their dividends over time. There's very few companies that actually pay a dividend based on how much they earn that year. What they do is they try to take advantage of investor desire for consistency and the like, and they smooth out their dividends so that even if they lose money, they're paying the same amount. And when they earn a bit more money, they still pay that same amount. So it's just about, again, getting that holistic picture. But to your point, Max, there is a behavioral side of it where if you find it simpler, great. You just have to keep in mind there's other stuff to look at, right? The dividend yield won't tell you the whole story.
I think if you wonder if investors care, just wait till a major company that's paid a dividend for 30 years cuts their dividend or stops paying their dividend. That will tell you whether investors care or not.
Yeah, even for a good reason. Even if they were to say for a good reason,
and they'll just lay off some people.
Well, sometimes a company will cut a dividend and the stock price will go up because the investor group will say that's good. They could use it. They need that money inside the company. But it's a big part.
Anything happens. I mean, to be honest, my only beef with dividends or dividend investors is if you're planning on becoming rich or retiring, you're not gonna do that with collecting $10 dividends quarterly, right? And I think like my plan eventually, because I did start off as a dividend investor, and then I realized like, hey, $10 quarterly is not going to get me rich. I need some growth in this portfolio here, and I only made dividends maybe 10% of my portfolio, and 80% growth. Now my future plan is once I grow that portfolio to maybe $500,000, then sure, I'll put that into dividend stocks, and not like maybe the sweet spot I think is around 3 to 5% for a sustainable dividend for a company to pay. But other than that, I see a lot of beginner investors just charging right into high dividend stocks. Not even not your TDs and your Royal Banks. Those are good companies that grow their dividend and their stock price. But I'm talking about companies like Bell Canada and the Yield Max ETFs and all those high yield dividend traps. So you're not going to get rich off of those. Go for the growth, but have a good balance of dividend stocks and growth stocks and ETFs. So that's just my take.
Yeah. And I think as Richard said, it's the underlying company at the end of the day, right? Dividend or not dividend, you can have a great company that pays a dividend. You can have a great company that doesn't pay a dividend, right?
I want to add one point on Max's question, talking about like on the personal side of things, like especially as beginners. So putting myself in the shoes when I first got started investing, I've always been a hybrid investor in every aspect of that. Like I invest in both individual stocks and ETFs, dividends and growth stocks, right? It's never, one side or the other. You can do a mix of both. But when I got started investing, I found that tracking my progress in terms of capital gains wasn't very intuitive because, I would keep adding money into each of those stocks. So my book value is growing. So then my percentage gain was kind of a little tough to kind of track and see the progress over time. But dividends are where I really got that really nice mental boost, seeing, oh my God, like every single year I can see my annual dividend total increasing exponentially. And that that kind of like motivational boost I got was invaluable for me, especially when I first got started. Like it really, I can't really overstate how much that helped me fall in love with investing and make me excited to keep investing and keep seeing that number grow. So that's why I think for beginners, they definitely, I think Joyee also touched on this point. Like as a beginner, once you start collecting dividends and like collecting drips, like reinvested dividends, you kind of get addicted. You kind of get hooked onto it.
Yeah.
Mm-hmm. And you should be cautious about that. Like don't get carried away. But investing and anything to do with money can be sometimes a little, boring or stressful or exhausting. So anything you can do to kind of get yourself excited about making that a habit, I think is a plus. And dividends kind of lend themselves in that regard.
Yeah. I mean, if you use your behavioral psychological biases or whatever to your advantage, then it certainly can help, right? Because even if you understand, dividend doesn't matter, but having a dividend stock makes me want to hold a company longer, then that's still going to help you. So the psychological aspect is something that's important and should.
I think it is, and I would argue maybe even more, especially for younger investors, because Bilaal, you'll say a $10 dividend. What deal is that? It's not the $10. It's the first snowflakes on that ball, right? And it keeps you investing. It gives you something you can track, and magically 10 years later, 20 years later, those dividends are a bigger number that actually make more difference to your. I mean, some people live off the dividends of their portfolios. That's what they spend. All right. So so Joyee, I think you're more on the line where this is your strategy. You're seeing the growth, and I think it's awesome.
Yeah, I mean, a lot of people also say, you're so young, why would you invest in dividends? And I think the main difference for me is that older people need to live off their dividends, right? I don't. I'm reinvesting my dividends. And so I'm not taking money out of my investing account to buy my favorite pair of shoes or makeup or something. I'm reinvesting the dividends. And I'm super jealous of Adrian's portfolio because every single month he will say, guess how much stock I got this month from drip. So I'm trying to be just like that.
But it took a long time to get there. Like my first couple of years, I didn't have a single drip, right? And once I got my very first drip, I was like, oh my God, I love this. I want more,
that's why I'm saying you gotta start early. So
and Joyee, to your point, like I'm the same way. I've never spent $1 of my dividends. I know, like BD, we always joke about you're spending your pizza dividends, right? But I always reinvest 100%.
I was gonna say that.
Dividends. One day, I hope to retire early, sometime in my 40s. That's my goal. Then at that point, I'm going to start, cashing out my dividends and basically living on them, right? Living off of them. But for now, I mean, my entire investing career, I've never spent $1 of my dividends. I've always been reinvesting, and that's such a reinvesting dividends are such like a clear illustration of compounding and exponential growth. It's hard to kind of visualize compounding when you're doing pure capital growth, but for dividends, it's so blatantly in your face, like that number increasing exponentially. It really kind of highlights the power of that.
It materializes.
To be honest, like
in front of your face.
Having like dividend, like getting that notification sometimes like at 1 a.m. in the morning, when you wake up, you look at your phone, and you're like, what? Oh, $50? Oh, wow. And then, but then not only that,
then you order another drink, right, BD?
My first dividend was 69 cents, and that's how I got hooked. 60 or 96 cents.
That's a crazy number.
That's insane. I don't know how you guys do 95. I'm getting 96 cents in dividends.
No, but you know what was awesome was during the bear market, whenever you got a dividend and then you just reinvest it, especially if your position was red, I almost saw it as free money to DCA into that position, which is an amazing mindset to have, especially when you use that dollar cost averaging strategy.
And
guys, I want to do a quick time check because we have gone over time, but we do still have like 300 folks tuned in with us. Are you guys down to go a little longer and take some audience questions?
Oh yeah,
I've got like 10 minutes, and I got to scram myself, but I'll participate as long as I can.
You can. Well, if you do have to leave while we're talking, Richard, it was absolute pleasure to have you.
Thank you. I'll just fade to black.
Or bring the baby in. Bring the baby in.
Richard, I'm gonna say you went for a bagel break.
Well, one I want to pull up because since we're on the topic and we talked a lot about dividends. But I know not all like yield is actually a dividend. So obviously, Richard, you said it's profit paying back to shareholders. So someone asked around the covered call ETFs, which are pay a distribution through essentially options, selling options. Is there any additional context? And maybe especially I don't know, Mark, or I mean anyone, but I know this is a very popular product. What are your guys' thoughts on these more broadly?
Yeah, so covered call ETFs, a little advanced, so I don't want to spend too much time on it because there might be a big chunk of the crowd that their eyes are glazing over with this. But the idea of a covered call is you're selling call options on the positions you hold, so that, and when you sell a call option, you automatically, it's almost like you're creating not free because that's the wrong term, but you're making money out of just selling a promise that the price rises to a certain point, you'll sell the stock at a given price. So people like covered calls because it kind of takes a portfolio of non-dividend, or it can take a portfolio of non-dividend paying stocks, and it can generate income off of that. The key thing to keep in mind, and I'm not necessarily someone who doesn't like covered calls, but you do have to consider sometimes they have fees. So because there's more trading involved, their fees can be higher than a typical ETF. The other thing to keep in mind is that's not free money. The way you're generating that money is trading off your upside. So you're basically saying, I have this portfolio of stocks. I'm going to cut off my exponential higher upside to generate a bit of income today. And that sounds great because it feels like there's no downside to that. But what you're doing is you're saying these stocks will no longer earn me a return above a certain threshold. So you're just changing your risk return trade-off. You aren't making money out of thin air. I think a lot of people unfortunately view it that way, where they're like, oh, it's free money. Like I have my portfolio and I'm just selling a covered call on it. You're just changing your risk reward trade-off. It's not cheating the system.
Very important to mention that, Richard. That trade-off that you're making. A lot of people don't have a clue when it comes to covered calls. They see the high yields and they go, oh, this is the yield I want. That's great. Again, not every covered call is constructed the same. There's a lot of different types of them, a lot of different strategies, a lot of different levels that they write options at. So if you're going to buy a covered call, you really have to dig in and understand what you're buying. One of the most critical things, I think, is of the differentiators between different types of calls. You can have one covered call ETF that says we're going to pay $1 a unit every month. And then it doesn't matter whether that fund generates $1 or loses $1 or whatever. That's what they're committed to doing. And in that case, there's periods of time you will go through, maybe long times, where the fund isn't generating enough, but you're getting paid that consistent dividend, or it's not a dividend, it's a distribution. And in that case, the money you put in, they're going to give you some of that back, return of capital. So that's going to start depleting that. Now, there are other structures that they only pay what they bring in, that they generate from the covered calls, and from, if you own stocks that pay dividends, that forms part of that pool that they pay out as well. In those cases, the dividend yield will fluctuate. If there's less yield generated in the portfolio, they're going to cut that they're going to cut that distribution down. They obviously like to keep it as consistent as possible because, again, people don't really understand. So if you go from $1 to 90 cents, because that's what the market is giving you right now, people will, potentially bail on the fund. That's one of the most critical things I think you need to look at when you're looking at a covered call ETF is, are they paying you, are they generating the yield and sharing that back with you? Or are they just paying it out regardless of what they're bringing into the portfolio? That's really key. And I'm not so sure I'm a big fan of covered call ETFs for the younger crowd because of that limited upside. Yeah. But for someone like myself, and I own one. Actually, I don't own one equity. I own a bond ETF that writes covered calls on it, but I don't own any equities that do that. I used to run a covered call program myself, and I decided, heck, this is just way, way, way too much work. So for the bond ETF that I do have that uses them, I sell it. I pay the fee to have someone else look after that. But that's also because of the stage of life that you're in. You may be prioritizing the extra cash flow into your portfolio. Yeah. The growth isn't as critical, but for a lot of people, they're not appropriate. But for a lot of people, I think that they are.
That's exactly it. Like, in my opinion, there's two camps of people that should be looking at it. Just to, like, summarize, like, the older folk. I want to just say older people. Dad,
hey,
you're mate. Who they are at a stage where that is more of the priority versus growing your portfolio. It's more so tapping into. I think they're a very good vehicle for that. And then I would make the argument too for people that are taking that very passive income style approach. Like, you take an Adrian, or you take even what we talked about earlier with the dividends discussion. Some people say, listen, I want to get my dividend income X amount month after month. Like, that's my goal to grow that. If that's like your set and true strategy, like a FIRE strategy, let's call it, where you have you're trying to get your income generated to certain levels, then I think it's a strong consideration. But certainly for a young person, like I as a 20-year-old, I would never buy a covered call ETF for myself. No reason to do that at this age.
Yeah. And one thing, not to hold us too much on this question, but one thing with option trading you have to appreciate is you might say, well, I'm just going to buy a covered call ETF for stocks that I don't think are going to shoot up in price. But one thing to keep in mind is the money you generate from a covered call strategy, all that's priced into it, right? So you'll get more money selling calls on high volatility stocks than you will selling them on stable stocks. So there's again, it's just you can't cheat the system, right? You're getting one thing but trading something else. So just something to keep in mind. And yeah, I kind of agree. I would add that honestly, for most, to an extent, it would require that, or I would say people should be a bit more advanced and understand covered calls before buying such an ETF. Again, the yield can look really attractive, but you have to understand the risks and the structure that you're getting into.
Yeah, and for those beginners in the audience, as Richard called out, if you're not sure what covered calls are, what options are, make sure you check out the Blossom.
Don't worry about it.
Don't worry. I had lots of good posts on Blossom, but we also have lots of cool courses breaking down some of those concepts. Some you can even earn money on.
One thing, sorry, Max. One thing I just want to highlight real quick. One line.
You don't want to know the answer to this one, Adrian? Okay.
No, Richard had an amazing kind of one-line soundbite, which I think is so important for every investor. There's no such thing as free money. There's no such thing as money out of thin air. Whether we're talking about covered calls, whether we're talking about dividends, all that money comes from something, right? It's never free money. So you have to whenever you're talking about different ways of extracting money out of your investments, whether that's passive income, dividends, etc., remember that there is a trade-off, right? You're costing yourself future gains or money that could have been reinvested in the company, et cetera, et cetera. So there's no such thing as free money. You have to just be mindful of what those costs are.
Not to be confused with free cash flow, which there is such a thing. It's not free money though.
All right. Well, I do want to know the answer to this question. So let's jump to the
I already know the answer.
Show us your feet, Brandon.
I was about the second I saw it, my leg just immediately started to come up on screen. I thought maybe I'm just not going to share my feet on screen. You know, on Instagram, I posted a picture with my foot just in the corner, and someone had a good time with that one. But
so, yeah, care about the Blossom community.
I think there's a sub community of Brandon fans.
The answer is
he wants to see your feet.
To be completely honest with you guys, there's a dog licking my toe right now. If I'm being completely honest.
Yo, Brandon, that's your Friday night, eh?
Yeah.
Oh my god.
What happens?
Well, how about I know Richard, you might have to. There's Bailey. I know Richard, you might have to hop off. Do we want to do one more question, or do we want to wrap it up and save it for a few?
Well, if Richard needs to jump, I mean, there's still quite a few people here in the chat, so let us know in the chat if you guys want us to go for a few more minutes. But yeah, Richard has to go.
Joey, you may have to go too. I think she's going goodbye.
Okay,
I'm happy to stay on for a few more minutes.
I can
I'll head off too. Actually,
Richard,
but thank you guys, and thank you everyone for joining.
Thanks for joining us, guys.
Chat for
you guys.
I can't wait to debate off camera.
Right, yeah, we'll save those dividends.
See you guys.
All right, bye guys.
One of the questions I've seen a lot, and there were some earlier on. This one from Julia, is it more focused on Canada or US? But also there were earlier questions, particularly around China and other geographic diversification. So yeah, who wants to talk to this one?
I think I've spoken on this a lot, but maybe I can start it off and then you guys kick it off. I'm like a huge believer in the US being the core. Now that said, like I think Richard made a good point earlier. You know, the S&P has done extremely well as of recent. Like the Magnificent Seven stocks have just propped up that index so well. And like right now, if you invested today $100 into the S&P, a good chunk of that is going towards these FANG stocks, right? The Magnificent Seven stocks. Is that a bad thing? I mean, I don't want to say it's a bad thing, but in my portfolio, I'm certainly happy to have some additional geographic exposure as well. And like I've done that via the ETF. So my all-in-one ETF gives me exposure to Canada. It gives me exposure to the European markets, the Asian markets. Technically, the ETF I have doesn't invest in China. So knowing me and my experience, like with the Chinese market, I might want to just put an ETF specifically giving me exposure there because I am like optimistic more than others on the Chinese market long term. But to answer your question, Max, my default is US being the biggest portion. We live in Canada. I'm happy to invest in Canada, not nowhere near as big of a weighting. And then, like I said, for me personally, I am bullish on China long term, as the followers do know.
I mean, look at Alibaba and all these Chinese stocks. They just blew up recently, right?
Well, of course that happens when I sell my.
You pulled
But also remember a couple of years ago the mighty downfall, right? So it's up now, but compared to 5 years ago,
it's because Brandon sold.
Very bumpy ride.
It's because
Brandon was the top signal.
There you go.
It's like what Kathy Wood did, right? Right when she sold Nvidia, and then boom, just goes
Right.
up.
Right. We
I'll
should
just
have
chime
mastered
in.
that when we met her that one
I
time.
should make that chart with Brandon. Brandon sold here.
For many years, the core of my portfolio has been U.S. based. That's primarily because they are some of the strongest companies in the world, and most of the U.S. companies that I own, U.S. domiciled, but they invest around the world. In fact, in many cases, more of their revenue comes from other geographical locations than the U.S. And so when we kind of have to be careful that way too. If it's a U.S.
That's
based
a good
company, it
point.
doesn't mean that all of their business comes from there.
Absolutely.
So
That's a super good
I
point.
get
That's a super good point, Dad.
yeah, I get
I
geographical
was just gonna say that too.
diversification that way.
A lot of people wouldn't recognize that. They, they're holding U.S. holdings, but actually the
Yeah.
business is taking place
Yeah.
in Asia, or they're
Well-
selling in Europe, so that
well,
they're
it-
actually exposed to
If
that
you
market.
if you see like a headline, like Apple could be doing amazing, especially with their iPhone 16 sales, and then you hear a headline, iPhone 16 sales down in China. Well,
Yeah.
and then the stock goes down. So doesn't that mean
True.
it has exposure in China?
Or
Yeah,
or
it
even
does.
even if we're talking about like even local companies, like one of my favorite companies in the financial sector is Manulife, right? Which is I think most Canadians know it's an insurance-based company. But if you look at their numbers,
massive
they
in
get the mass majority of their number of their revenue comes from Asia.
Yeah,
Only
they're
like 30% comes from Canada. The rest is in China, Singapore. Like it's huge there.
That's such a
Um,
good point. So
yeah.
you could look at the portfolio, see Canadian stock, but in reality,
not
you need
really
to understand
Canadian.
Connected
right?
everywhere. Yeah, like Brookfield as well. Brookfield's an international company. They have infrastructure globally, right?
So you can be very niche in a country, or you can go more broad.
Yeah. One thing I'll say is, a common question people ask me is like, oh, what was the biggest investing mistake I made? For me, my biggest investing mistake was that I kind of neglected the international market. So I'm similar to Brandon in the sense that my core is Canada and US. I think I'm more heavy on Canada than Brandon is. But from day one, I was basically 50-50 split between the Canadian market and the US market. But I went years and years completely neglecting, the European markets, the Asian markets, South American markets, right? Now, years later, I've kind of, rectified that mistake. And now I kind of invest maybe like 20% of my portfolio into ETFs, either Canadian dollar or US dollar ETFs, which track those emerging markets, those more well-established international economies. But one of my regrets is that I missed out on years of that international growth. So I think,
Adrian, what the good thing about Blossom is I always thought Adrian only used to be like a dividend investor or REITs, and then with Blossom, I got to see that hey, me and him have something in common. He likes tech stocks just as much as I do, right? And I gotta give a shout out to Max and Brandon for creating Blossom for this opportunity. Otherwise, I would have thought Adrian was just a dividend loser. I'm just joking.
Bragging about my 10 cents a month dividend. Yeah.
The debate starts after hours.
Amazing. Well, what one comment here? I'm curious your guys' thoughts on this. Someone asked about this as well. I know for China, there's a couple things. One, people have called out financial information might be wrong sometimes. Two, I've heard that you don't technically own the stock. Does that change how you guys think about investing in the Chinese market?
I'll chime in there, and this goes back to at least 30 years ago when I was a young advisor and I was in a meeting and there was some portfolio managers, and you kind of look up to them and these guys know everything. And one of the fellows specifically was justifying to the group he was speaking to why he wasn't investing in Asia generally. And he said that he just didn't have confidence in the numbers that came out. And of course, when you're managing your own money, you're responsible for that. But when you're managing money for other people, and something blows up, the level of the fiduciary duty goes way, way, way up when you're looking at someone else's retirement account. And so he just never felt comfortable. And maybe that's stuck in my head. I'm not sure. I've always felt there's so many opportunities that we have here. Yes, the books aren't always 100% accurate, but I have more faith in the regulatory bodies in North America, even in Europe, than I do there. So I just go, why go there? If you're at a buffet and you like, a whole bunch of seafood, and there's some stuff that looks a little bit off, but it might be really delicious. I'll just pick something else, not even take that risk.
Yeah, but then Chinese stocks could also be great like investment opportunities, right? You have companies like
they can be absolutely.
No, but you have like companies like Tencent and Alibaba who also have some U.S. and Canada exposure in terms of
Mhm.
you know their websites and whatnot. So
At this point, those companies of that stature, you know, obviously you get the odd one out. Like, you know, you get the Luckin Coffees. You get companies even here in America that are cooking the books, or they're doing something not
Yeah.
properly.
yeah,
You get that everywhere, and certainly you'd see that a lot more there. I do think that is somewhat of like a past, was probably a lot more common a decade ago,
Maybe.
2 decades ago, because yeah, when you're talking about the companies of that stature, BD, like that are doing global business and that
yeah,
are
yeah.
at this stage, I do have confidence in the numbers, Max. To answer your question,
Mhm.
again, maybe as much confidence as North America, maybe not. I guess one of the things, like I have a lot of ties to like the Asian culture. Like my wife's, you know, Asian, right? So I've been there. I've seen it. And I've seen it firsthand. It's actually one of my favorite places to go. Why I'm so optimistic on China, in particular, Taiwan Semiconductor, is these are some of my
Yep.
favorite places in the world. And you know, you grow up hearing about what it's like over in China. And again, maybe in the past it was more like this, so that's fair. But I'm talking about current day 2024. You know, those nations, I look up to a lot of the things they do. I think they've actually got a lot of stuff figured out, probably more so than we do here, with all due respect. And I think it's maybe the communication, how we view it, is still up for grabs. But at least my own personal opinion from, you know, traveling there, being there, I'm quite optimistic on the future, and the cook in the books type of thing is something I'm less worried about.
Less worried about. Fair enough.
I mean,
And
it
like,
comes
I
back down
respect,
to
sorry, Bilaal. I respect what you said, Dad. Is that for you personally? Maybe that's not. That's the whole point. Is that some people, it's risk. It's how much risk are you willing to take? Some people don't do this. Some people do. It's natural.
Yeah.
I mean, it comes back down to stock picking. You know, like you could have picked Alibaba or you could have picked Luckin Coffee. But if you want to avoid that issue, then you just go for emerging markets ETF or
Yeah.
Play the field.
a straight Chinese
Yeah.
ETF. That way, you have the experts looking at the numbers.
Yeah.
You have
I
a
was
better
gonna, I
chance.
was gonna make that exact point below. Like
Yeah.
now I told you, I about 15 to 20% of my portfolio is in international markets, but I don't own a single individual stock internationally because it's
Correctly,
hard.
yeah.
Like to buy stock on the Tokyo Stock Exchange or the German Stock Exchange or the London Stock Exchange, it's expensive and you have to jump through so many hoops. I don't do any of
Yeah.
that. So all of my international exposure is Canadian domiciled or US domiciled ETFs. They handle all the work. They have they track the indices, they track the emerging markets indices, the developed economies indices. They're the ones that kind of pick out which international stocks are worth investing in.
Yeah.
I just put my money in and they handle the currency conversion, all that stuff.
Yeah.
So
Yeah.
it's so much easier going the ETF route, especially for
true.
international.
So true.
Totally true. The only equity ETF I have happens to be an Australian banks ETF, and you know, hey, they can look after all the behind the scenes stuff. I just want to own those banks.
And you bought that through like the Australian exchange?
No, I bought a Canadian domiciled ETF that does
Right.
the holdings are from there.
Mark, have you ever bought an international stock directly?
Not directly. I've bought
Yeah.
ADRs. Yeah. Not
Right,
directly.
right.
I don't think so. Goes back. My memory's starting to fade. This could be a long time ago, Adrian. You got to understand, but I don't think I ever have.
Fair enough.
Well, guys, we've hit the hour and a half mark, and I'm mindful that maybe we're best to wrap up and then save the rest for a future live stream. What do you guys think?
I wish we could sit here for 4 hours and answer all the
know.
questions that have come in. Yeah.
With some
Yeah,
cigars,
yeah.
right, Mark?
What's that, BD?
With some cigars.
With some cigars and a
Well,
glass of
all
scotch.
this is telling me is that there's a need for a next part 2, and I know Taxi Drive. This was sort of like a test. We wanted to see whether there would be interest in us doing live streams like this, and this one was much more of a general discussion. We want to do more of these, even deep diving into specific topics.
It could be one specific topic. Hey, think about that. Like,
Yeah.
even these past couple topics we discussed, there could be an hour long with additional follow-up questions from the audience, from you guys, and absolutely.
And also we would definitely appreciate feedback from the audience. Like what worked? Like what's the panel size? Like we don't want to have too many cooks in the kitchen, right? But I feel like 5-6 people, I think that's a pretty reasonable. I think this chemistry works. We might do panels with smaller groups. I don't know. We'll see. But feedback from the audience would be appreciated.
Maybe we'll just kick you out for the next one, Adrian. And
Yeah.
I just want 3 people at once. Yeah, I can do that.
Yeah, and I'm sure Nika, we can.
Oh, there she is.
Sorry, I added you guys. I'm sure we can send out a survey after as well, and get people's thoughts. But no, there were so many great questions in here. There was questions about the Indian market, about more specific ETFs, about which accounts to max out, and I think we're best. Let's save the anticipation for the next the next panel. And even in the survey, maybe we can get a gauge in which topics folks want to dive into. But wow, there's still
Thank you guys. Yeah, shout out you guys. Shout out you guys on a Friday night.
Yeah. Appreciate you all.
And Max, just to confirm, this video will be posted on the Blossom YouTube channel, correct?
Yes, this will be on the Blossom YouTube channel. And yeah, same with Mo. Shout out Anika and shout out Brandon for organizing this panel. Unlike the events, I didn't really have to do much. I just sort of showed up and asked the questions. So shout out to you guys for organizing. I'll pass back to Nika to wrap us up here, and then we'll let everyone get on with the Friday evening.
Quickly to wrap up, thank you to all of our speakers and our moderator, Max. If you guys don't already, make sure to follow all of our speakers on their social medias and on Blossom. Their handles are put up in the screen above. And for the very few people who are listening in who don't already have Blossom, make sure to join the community. You can download Blossom here using this QR code. And thanks again. I'll be sending out a feedback form. So please let us know your thoughts, whether it's in the comments. You can DM us on Blossom. You can, reach out to us on socials. We want to hear your thoughts. And thanks again to everyone for tuning in. And we'll catch you on the next one.